A September rate cut by the Federal Reserve is on the table for their next meeting. The latest developments for inflation and the labor market have made a rate cut all but a certainty at this point. In today's video, we're going to look at what happened at the Fed's meeting last month, go over the latest data on inflation and the labor market, and assess what this all means for mortgage rates and the housing market in the months to come. Let's get into it. At the Fed's last meeting, they decided to leave interest rates unchanged, which wasn't a surprise given the lack of signaling that they were ready for a rate cut at that time. But that changed after their last meeting. At the post-meeting press conference, Jerome Powell told reporters directly that a September rate cut was on the table if the inflation data continues to be encouraging. Since that meeting, the inflation data has indeed been encouraging. As I mentioned in my previous Mortgage Outlook video, we were likely to see CPI inflation head below 3% in the next report, and that's exactly what we got. The year-over-year change in the CPI came in at 2.9% in July, down from the 3% reading in June, and the first time it has been below 3% since March 2021. Importantly, both shelter and non-shelter components of CPI headed lower for year-over-year changes. The rate of inflation for shelter came in at 5%, down from 5.1% in June, and the non-shelter rate of inflation came in at 1.77% in July, marginally lower than the 1.81% in June. This was exactly the kind of inflation report we needed to see. As I also mentioned in that previous Mortgage Outlook video, getting that CPI reading below 3% would pretty much seal the deal for a September rate cut. To make the case even stronger for a rate cut, we also got a report on the labor market showing slower growth there as well. Monthly job creation slowed down to 114,000 non-farm payroll jobs in July, down from the 179,000 in June and 216,000 in May. Remember, the Federal Reserve has a dual mandate: stable prices, but also full employment in the labor market. If they leave their Fed funds rate too high for too long, it will slow down the economy and the labor market with it, potentially pushing us into a recession. So with the favorable inflation report, as well as evidence of slowing in the labor market, the Fed has every reason to cut rates at their September meeting to try to hit that miracle of a soft landing where they bring down inflation without pushing us into recession. Now, for the big question, what does this mean for mortgage rates and the housing market? For mortgage rates, we've already seen movement in the bond market and 30-year fixed-rate mortgage to give us a preview of what's coming. In anticipation of a September rate cut, the bond market has sent the yield on the 10-year Treasury down from a recent peak of 4.65% back in April. After the Fed's meeting and confirmation from Fed Chair Powell that a September rate cut was indeed on the table, the 10-year Treasury yield went sharply lower, down to 3.79%. It has since trended sideways for the most part since then, and likely won't head too much lower until we get more signals from the Fed that the September rate cut is going to happen. Such a signal could come this Friday, August 23rd, where Powell will be delivering a speech at Jackson Hole. With the 10-year Treasury yield heading lower, the average rate on a 30-year fixed-rate mortgage has headed lower as well. It's gone from a recent high of 7.2% down to 6.5%, the lowest since May of last year. Since we've already seen mortgage rates come down in anticipation of a September rate cut, could we see more downward movement once the Fed actually cuts rates? A September rate cut has already been priced into the bond market for the most part, meaning that bond traders buy and sell based on what they expect to happen. So when it actually happens, there isn't a lot of movement afterwards. Markets are forward-looking in that respect. But there are a few key things to watch before and at that September Fed meeting that could lead to further declines in Treasury yields and mortgage rates. First is the economic data released before their next meeting. We'll get another jobs report released on September 6th and another CPI report released September 11th. If monthly job growth remains soft and annual CPI growth ticks down again, markets could speculate the Fed would opt for a larger than anticipated rate cut. This would especially be the case if job growth were flat or negative. And that leads to the next thing to watch: the size of the rate cut at that September meeting. A quarter-point rate cut has already been priced into markets, but if the Fed surprised with a half-point rate cut, I think the bond markets would send Treasury yields further down in response. Next, there's the language in the press release and Fed Chair's press conference. If there was any kind of signal there of further rate cuts this year, that would also likely trigger a response from the bond market. And finally, the Fed will be releasing their quarterly update to their economic projections. In their last projections in June, there was only one rate cut projected. So if those change to show a second or third rate cut for 2024, that would also likely trigger a response from the bond market that sends Treasury yields lower. And where Treasury yields go, mortgage rates soon follow. So if we get a perfect storm of these key factors we're watching, we could easily see mortgage rates go below 6% by the end of the year, and possibly soon after that September Fed meeting. A lot of things would have to happen just right, but it is possible. The next question is, what would that mean for the housing market? Over the last few years, real estate activity has been heavily influenced by mortgage rate trends. Going back to the onset of the pandemic, we can see when the Fed cut their Fed funds rate to zero, mortgage rates came down with it, and then we saw home sales shoot higher. When mortgage rates started going up as the Fed was raising their Fed funds rate, home sales came down. From this chart, it looks like home sales have generally trended sideways over the last year, but when we zoom in closer on this time frame, we can see a similar correlation. When mortgage rates peaked back in October 2023, sales hit a low point. After mortgage rates started coming down in anticipation of several rate cuts in 2024, we saw a rebound in home sales. Then mortgage rates went up again as markets were disappointed the Fed hadn't cut rates yet, and it looked like they might only cut once, and home sales retreated again. And now we see mortgage rates coming down most recently based on anticipation of that Fed cut in September. And what a surprise, we're seeing an uptick in sales again. But because home sales have been so low the last year or so, there are a lot of buyers on the sidelines that would ordinarily have purchased a home if prices and mortgage rates hadn't been so high. It's all about affordability, which has eroded terribly the last few years. The average housing payment as a share of the median household income was 39.9% in July, well above the 30% level where the government says a household is cost burdened, and also higher than the 36.5% peak we saw in the last housing bubble. For so many buyers, a home is just out of reach. Prices haven't been coming down, so in the short term, only lower mortgage rates will help improve affordability. Hypothetically, if mortgage rates were to fall below 6%, say to about 5.75%, which might be possible if everything goes as I outlined earlier, the average housing payment as a share of income would fall to 36.1%. Still above that 30% level, but gets us below the peak in the last housing bubble. This would be enough to bring in more buyers at the margins and potentially attract more homeowners to list their homes for sale as well, given they would be in a better position as buyers to purchase another home after selling their current home. Lower mortgage rates would definitely lead to more real estate activity, but home sales are unlikely to return to the pre-pandemic trend this year. For mortgage rates to go lower than 6% to make a real difference, several things need to go just right. To recap, there's the economic data before the Fed meeting in September. If the jobs report continues to show weak hiring and inflation keeps trending lower, markets might start anticipating a larger rate cut or multiple rate cuts this year. Second, there's what the Fed actually does at that September meeting, whether they do a quarter point or a half point rate cut. A half point cut would likely result in the bond market sending Treasury yields lower, given that a quarter-point rate cut is what they have priced in currently. Third, there's the language in the Fed's post-meeting press release and Fed Chairman Powell's press conference, as well as their revised economic projections. Any indication that more rate cuts are on the way for 2024 would also likely lead to the bond market sending Treasury yields lower and subsequently mortgage rates along with them. These are all the key factors to watch in the coming month leading up to and at the Fed's September meeting. What do you think? Will the Fed cut rates at that September meeting? Will they go big or stick with a small rate cut? And where do you think mortgage rates will end up for 2024? Let me know in the comments section below. I'd love to hear your opinions. If you want to stay up to date on all the developments as they happen, make sure you're subscribed to this channel and hit that notification bell down below so you won't miss my update videos as they are released. I'll be monitoring everything as it happens and let you know what it means and what to look for in the months ahead. And if you found this video useful or at least mildly entertaining, please hit that like button to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.